Morning, folks. It's the 4th of March. We are Signal Centre Talking Ball. I'm Joe Neighbour, joined by Steve O'Hare. Good morning, Steve.
Morning, mate. All right.
Not too bad, thank you. How about you?
Yeah, okay. I've got my Peloton arriving today.
Wow.
It's got me by surprise. I thought it was tomorrow.
Oh, okay. What time's that been delivered? Have you got any idea?
Not a time, no. Just it's a month late, but so it doesn't really matter what time.
Can you do Talking Ball tomorrow from the Peloton?
Yeah, quite easily.
Yeah. So
you asked me to do it.
Swap out your chair for the bike.
Yeah.
It's got a bit of a screen in it, so you probably link it up.
I'll be trying to cut it short early. Yeah, you could. Yeah, I don't know what you can do with the screen if you can link it up or I think it's quite restricted because they want you to use their software on it.
Of course. So are you prepared for your first session on that today then?
No, absolutely not. Just
I'd love to go on my bike today. It's pissing down with rain, so I'm not going to go out.
Yeah, you should get yourself a Peloton, mate.
I would if I could afford it, Steve. You're not paying me enough.
No, get yourself a Peloton and a Klarna account.
Yeah, maybe what I need. Yeah. Okay, fantastic. Right, so what's going on in the world of markets? So there was a bit of a sell-off in equities certainly last night. We saw it in the US markets into the close and in Asian markets overnight. And it's again to do with surging sovereign bond yields. So we're continuing to see government debt pay out decent rates of income to people, and it's again back to that question: at what point do investors think there's no point in me taking any more risk in the stock markets when I can achieve 2.5%, 3% by owning government debt, which is essentially classed as pretty close to a risk-free asset? So while that's boiling under, I think it is threatening potentially the equity markets, and we could end up seeing a fairly substantial correction maybe in equities in the coming weeks.
Hang on, let's not get carried away.
Well, at some point there's a trade-off there, isn't there? And it's
I just, as you mentioned them, I thought I'd jump onto the 10-year and the 30-year chart on the government bonds and just do a little bit of analysis on it, and maybe sort of there is a little bit of hope out there that these won't get too carried away. So I've obviously drawn this bearish channel on. This is where yields have gone since 1986, all the way up at 10%. That was fun when I bought my first house and interest rates went through the roof. I think mortgage rates went up to 15%. So that's what we've seen. But since then, over my housing career, obviously you've seen this yields come off. So this is quite relative to global yields, really. I mean, there is a difference between them all at every specific moment, but this is what they've all tended to do. They've all ground lower. And obviously we got to a low of around about 0.35 in the 10-year, and we've seen this real big rally over the last 6 months, really, and it is a concern because I don't think anyone, even the governments of the world, can afford the debt payments if we start to see these things spiking. 30-year,
wow. I
mean, again, it's quite a sort of like from 1987, really, when we saw 11% rates on a 30-year. That would have been a decent investment, wouldn't it? You'd be just getting paid out on that now, wouldn't you? 30 years. So so we've seen
this. It just looks like a correction within a downtrend, right?
Absolutely, and there's no doubt about it. We are in a downtrend. Even in looking at the daily chart, you've got this congestion level towards the end of 2019 where we saw this low of 1.9, just broke the 2% level on a 30-year yield, which is bloody low. Don't get me wrong. I think sort of like around about a 2%, 3% it seems to me like a fair interest rate to be charged on things. But the problem is we're in such a debt-laden society that this impacts on everything, and rates sort of like will take it from the 30-year and sort of build it out, and it'll escalate quite quickly. But like you say, it is just a correction. Even if we take it back from November 18 and we get some sort of like fibs in there, because this was a sort of like a swing high from the 2015 2016 levels. I mean, a 61.8 you know, we've
Healthy correction, right?
Yeah, that's a decent correction, and it's sort of like, you know, I think you're sort of seeing a little bit of slowing down of momentum. I mean, even let's have a look at the MACD. I mean, it's at sort of like really decent levels, but you can see there is bearish. What's the word I'm looking for, Joe? It's going up and it's going down. Bearish divergence. Yeah. So look, you see the bearish divergence since 2019. Well, definitely since March 2020 when the pandemic hit. Look at that.
Yeah.
You're getting this move down while the price is going up.
You're looking at the histogram rather than the lines, right?
Yeah, the histogram. Sorry, these lines. I'm not really looking at the lines.
I was looking at those thinking, what's he talking about? Now it makes sense.
So yeah, I always like to pick the histograms. The lines are obviously far more reactive, and there's a lot more that goes into them. But the histogram for me is the one to look at. And yeah, that's decent bearish divergence, and I think the 61.8 could cap it.
Yep.
So I wouldn't, you know, although it sort of like seems bad on the 10-year, 2%, for me that's a top, a potential top. So yeah, there's well, even looking at the 4-hour chart on the 10-year, we've seen the swing high 1565, and we failed here. So that looks like a bit of reversal. It's broke below 146, trading at 145. And really
just into cloud support, isn't it?
Yeah, but even on the hourly chart, I sort of think, you know, you got sort of like a bit of a level down here, 138, that if we get below there, it's all over. I don't know, it's sort of, I wouldn't get be too worried about it just yet, but it is something to keep an eye on.
Yeah, I mean, obviously it's I imagine it's to do with the inflation situation as well. As that continues to creep higher, you know, people are assuming that governments are going to have to increase interest rates in order to curb it. But you know, there's no sign that that's the case at the moment in terms of the rhetoric and what they're speaking about. You know, they're keeping an eye on inflation, but they're not overly worried about it, and they're obviously trying to boost that to get the economies moving again.
Yeah.
ECB policymakers, they're downplaying concerns over the yields ahead of next week's meeting. I think we've got what we've got today. Fed today, have we?
Yeah.
Fed speakers. So he'll obviously be talking about the impacts of Treasury yields and, you know, the concerns with that at the moment. So he will remain as accommodative as ever, I have thought, when he speaks later today. Jerome Powell, that is. So we'll wait and see.
Yeah, I think it's that, you know, there's obviously risk there, but it's not at levels where we have to be overly concerned. I don't know. I just think sort of like governments themselves can't afford the rates to go up, so they'll be doing everything in their power to sort of come up with an alternative solution.
So you've got the oil chart on the screen there, Steve. We've got OPEC plus meeting again today. Energy watchers are still sort of guessing about what the market will do and whether or not there'll be a supply increase in April as it's been expecting. What are you seeing on this at the moment?
Yeah, as sources saying that you know, they're considering rolling over production cuts into April instead of raising output as a recovery in oil demand remains fragile due to the coronavirus. So that's from 3 OPEC plus sources that have said that this morning. Yeah, weekly chart, obviously we know we're battling with this long-term downward trend in resistance line. It's quite an interesting battle. On the 4-hour chart, for me, this is the sort of like the level to watch, where 62.16 on the WTI crude oil, anywhere around here could form the left shoulder. Let's bring it out to here. I think you've got resistance from here, resistance on the cloud still. Obviously, a break above the head would negate this potential formation completely. Let's see what the measured move target is on this. Measured move target, we measured the top of the head to the neckline and extend it lower from wherever the neckline breaks, if it does break. So if that does break, we're heading towards $54, $50, $55. But still a lot to do before that plays out. We've seen a little bit of stalling in this correction. We've obviously had the turnaround. This is the right shoulder we're looking at on an hourly chart, and we're seeing this corrective move up through hourly cloud support. So there's a little bit of positive impetus coming in on the short-term timeframes, but again, it's this could form a double top here. Here. So a break of this neckline here, 60.53, which isn't too far away, and we could see this this move reversing quite aggressively. So oil, although it is positive, it's not a solid positive situation for oil. Gold, as you all know, and you're probably bored of it, I'm looking at this corrective leg, this B to C leg that we're looking at, and within it we've got a three-wave correction. Don't know where the C leg is going to finish yet, but when it does, I expect this flagged formation to form. I'm looking at around about 1660, 1670 in gold as a real sort of solid support. A break of there, and we could get sort of like a correction even down to the 1450 level. That would be, in my eyes, a real decent long-term support and potential area to ship the gold in. On the shorter term charts, we continue to be grinding lower in this flag formation. We can see it here. Still looks like there's a bit to play out, so I'm still hoping for continuation of this negative move down towards the, well, we got almost a retest of the 1700 level, psychological level, but a really quick reaction bounce from there, but we haven't extended higher, so I think we're going to have another bit of a go at it today. That'll be my gun to the head, I think. I'm going to stick with it, whereas normally I switch halfway through, but it seems to have worked quite well this week on a intraday plan.
Nice.
Indices, like you said, Joe, a little bit of a correction lower yesterday. We can see the move down. This is the Dow. It failed to get above the 31,675 swing high. It's just failed in front of it, 31,640, and then quite an aggressive sell-off in there. Nasdaq, a little bit more aggressive to the downside, and we're below the hourly Ichimoku cloud, although we are seeing a little bit of a turnaround. Wouldn't be surprised if that sort of like we continue this grind higher into the US session, and then they'll decide what to do. And the S&P playing around with 3,900 last time we spoke yesterday morning. We're down at 3,800 and we've been below it as well. So quite an aggressive sell-off in the S&Ps.
And so leading the way, isn't it? People,
yeah.
I mean, what's going on with tech? I mean, it's maybe just valuation concerns and people
it's massive,
a
isn't
realistic approach to it.
The sort of valuations they're putting on the tech sector is quite a sort of.
How does it look on the daily chart, Steve?
On the Nasdaq, on the daily, we've got the ending wedge formation, which we've been talking about, and it's been below it. Isn't it? Well, look at that. I mean, we've been playing about with it for a while now, but these last 2 days, and we've broken below the 12,735 level. So
what's that set up, do you reckon? I mean, it clearly looks to be a bit of a top pattern on there, but I mean, first step, maybe a 38.2 fib would be a healthy correction. I mean,
yeah.
If you started saying that to people, they think, no, it's never getting down there. But,
exactly. Oh, that's, I think that's sort of, if we sort of drill down a little bit into these levels here, obviously we've still got a little bit of support around here, there, 12,485. Then you'll find a little bit of support here, which is a swing top rejected, swing low, and then sort of like the extension of the move over. That's 12. It's coming in around about 12,200. And again, these levels are 400, 500 points away. So it seems a bit weird talking about them sort of points on a on the daily chart. But
just knowing what we do about the sort of mentality of retail investors, they'll be looking at this thinking, oh, this is far too cheap now. These stocks have come off whatever they've come off. and they'll be piling in, won't they? Here, and it won't be long before they're averaging in, doubling up, holding on, and then they're in that sort of despair phase. But it could easily unwind to that 38.2, I think.
Absolutely, yeah. There's no
And
doubt about it.
and there'd be nothing wrong with that. It'd still be, a fantastic bull
bullish
case to invest in the US markets. But that is, there could be that, couldn't there? I mean, what would
Yeah, I'm always looking for head and shoulders formation, as you know, Joe. And for me, this could be quite a decent one.
Arguably, it's completed. I mean, where's the measured move of that? You've already got it on there, have you?
Yeah, I think I already drew it on from before.
So would it be a bit of an extension, maybe a 127 or 161 extension to get down to that 38.2, maybe?
Well, I mean, if you draw it from this move down, the sort of first sell-off,
yeah, 261.
You're looking at you're looking above the 161.8. So
where's that 38.2 coming with though? What's that?
That's coming in at just below the 11,200. On which one? On this one? On the orange line?
Yeah, you've got a confluence there, right? So you've got 38.2.
Yeah, 11,130, 224 extension. Yeah, and look at what happened previously back here. So that sort of level is not beyond the realms of possibility. I don't know what the catalyst will be. There would be a huge amount of panic, but maybe it would be Elon Musk saying, I don't know. No, every time he sort of like plays down his own share price, it seems to rally. So maybe
it's one of his fingers blew up. Rockets blew up yesterday, didn't it?
Oh, did it?
I think there was a prototype that landed somewhere, landed fine, and then shortly after it landed, it exploded. It was unmanned, but it was the prototype for the vessel that he wants to take people to space in. So.
Oh right, okay. All right.
Yeah, I'll let someone else go first. I think.
Do a bit more testing, please.
Yeah. Okay, fantastic. Does that round up the indices?
Yeah, that's it. Yeah.
Lovely, thank you. Okay, so on to FX. I mean, I think it's more interested in indices and commodities at the moment, personally. But this is just sort of the overview again of the currencies, and we've got this blue line here, which is the dollar index, which is always sort of the main point of interest, I think, with FX, because it tends to have such an influence over everything else. But as you can see, that's ticking higher and looking quite bullish. But I mean, still the Japanese yen and the Swiss franc are looking pretty negative. They can't really catch a break. They continue to be avoided, even though they have sort of safe haven characteristics. So maybe we'll start to see a bit of a turn in those soon if the equity markets do pick up a bit of steam on the downside. Elsewhere, British pound still remains elevated. Obviously, we had the budget in the UK yesterday, and sterling remains reasonably strong. If we look at the dollar index on a standalone basis, still looking for this potential bottom pattern to take shape. So while we're waiting, I think we're going to continue to see choppy price action in and around here. And what would need to happen for me to be convinced that the dollar index was going to have some sort of meaningful move higher is for us to take out this resistance level here at 91.60. That's the swing high that we saw back on the 4th of Feb. If we take that out, then sort of measuring this move here from the lows on the 6th of January to those highs on the 5th of Feb, then we're looking up here around about 94 level for dollar index, and that would be a decentish correction. If we look at the daily chart, just to put that in some sort of context as to where that would take us, let's have a look, see if any fib levels match up with that to get a bit of confluence. There we go, just fairly close to the 38.2%, and that would be seen in my mind as a pretty healthy correction, really, in the dollar index, given the viciousness of the sell-off that we've seen over the last few months or so. So keep an eye on that. I think that's the key level to watch, around about 91.60 on the dollar index. If we look at sort of currencies around that, still look pretty good on the Aussie front, certainly against yen. As we said, the yen continues to be sold off, so we're still very much trending higher here. I've highlighted this level 81.97 on Aussie yen. If that breaks down, then also we'd see a break of the trend, and therefore that could lead to a correction lower. But while we're in that trend higher, I think it's a case of just buying dips. Similar with Aussie dollar. This level here, we did see a little bit of a break lower, but we're back within this channel now. I think 76.92, if that gives way, then again we could see a corrective move lower in the Aussie currencies. Elsewhere, I think it's just more of a continuation of the same, really. Sticking with these trends, this is the daily on Euro Oz. Again, continues to trend lower. Euro Sterling continuing to trend lower. We did obviously have a little bit of a poke above some resistance levels last week, but stalled at 87.31. So while that remains a sort of cap to the upside, then I think it's a case of continued lower prices. Euro Yen continuing to trend higher, nothing changed there. Euro New Zealand trending lower, and until that breaks, it's a case of continuing to sell rallies. Euro USD looking a little bit interesting. We posted this big shooting star candle on the 25th of Feb, and arguably we have seen a break of trend. I mean, you could arguably have drawn the trend up to that swing low there and then say that we've broken that and that we're actually just seeing a retest of this channel. So Euro US dollar probably looks maybe the most vulnerable, but I think if we break that 91.52, that's what we would need to see in order to really accelerate the bear case on Euro US dollar. So maybe some more choppy price action in the very short term, keeping a close eye on this 91.52 level. And on cable, that just continues to trend higher. We did see a bit of a poke above the upper end of this channel, and then some sellers step in, but we've got support around here at the lower end of the channel. So while that remains the case, I think we may see continued choppy price action, but with a bullish bias for now on cable. Everything else, I think it's just more of the same, trending higher, trending lower on dollar CAD, but obviously keeping an eye on this wedge pattern. If that breaks out, I'd be looking for a move above 127.40, and I guess that would coincide with a breakout in dollar index as well, or something close to it, and then maybe we could look for a bit of a turnaround in that. That pretty much sums it up for me on the currency front.
Lovely.
Okay, so just another news story I thought was quite interesting, Steve. Melvin Capital Management, this was the hedge fund that got their pants pulled down on the GameStop situation from Wall Street Bets. They're on a comeback trail. They adjusted their strategy and they pulled off a 22% gain in February, which is about 8 times the return of the S&P 500. So that was pretty impressive. Basically, they've stopped using derivatives that show up on the quarterly filings. So they're hiding, basically, or not hiding, but just being a bit cleverer about what it is that they're involved in. So it's not allowing them to be singled out by the retail crowd. And I imagine there'll be a lot more firms trying to do that as well, given what we've seen. Apparently, that cost them $6 billion. From the GameStop situation. So I thought that was quite interesting. Okay, so gun to the head trades from yesterday. Let's have a quick look at that. Steve, you're on a bit of a streak at the moment.
Lovely.
Yeah. So
that was Ian holding me back, wasn't it, Ian?
Yeah. Maybe so. So what did we do yesterday? I was stopped out on euro dollar, although it did eventually go where I wanted it to, but stop loss was a bit too tight. Okay, here we go. So I had a 1 hour loss, 33 ticks down on euro dollar, but Steve, you were 13.5 ticks to the good on gold with a 1.13R return. So overall, we made some money on the day, and our comeback continues. Hopefully we can continue this. Certainly you can continue this because it's going very nicely, and you can pick us a winner. You've already hinted that you're going to look at gold again, so I'll hand it over to you and you can finish the job.
It's funny, while you were chatting, I was sort of like looking through the markets and I end up at copper, which we didn't really cover. Now copper's having a bit of a correction lower. It's had a huge rally, exponential type of rally, obviously with the demand really picking up as the economy opens up again. But we've got this shooting star on the weekly chart, which is leading to bearish price action. And I think I had some sort of notification this morning, can't find it now, but telling me that copper had a a decent reversal. So looking on the daily chart, I do think we're potentially A, B, C, D correction. Could bring it down to around about the 390 level. But I thought I'd stick with the plan that I mentioned and not change and go with gold again. Now, ideally, I would like to sell around about the 17 and 18, 17.20 level, which is where my stop is, which is really frustrating. I'll tell you what, I'm going to move my stop higher, take my stop up to a better level. Getting short at 17.11. I'm going to have the stop at 17.23. And that means I've got to look for a bit more of a target. We'll go for, what about 1687? Around about the 1690 was where I was looking to take profit. So I'll probably be very frustrated if it gets down to 1690, then jumps up again. But yeah, I'm trying to sort of like keep my risk reward. Only 2 to 1 today. But you know, if we could only do 2 to 1 every day, we'd be very happy. 1687. So I've set my alarms on there, getting short in gold here at this current price, 1711, and then stop at 1723, target 1687.
Super. Good luck, Steve.
Cheers.
Okay, I'm going to take a look at Aussie Swiss. A little bit exotic compared to what I would normally look at, but just flicking through the charts, and I quite fancied this one today. So we've seen a correction that took place over the last few days, going back to the 25th of Feb, and we've seen a push higher towards a 78.6% fib level of this swing move down here. We've also got some bearish divergence that's formed on the hourly chart. And in the last few hours or so, we've seen it hit this 78.6 level almost to the tick, and post a tiny little reversal. Now, also what I like about this is that it's actually above, or went above the average true range bands that I have on the market in the last few hours as well. So thinking it could be possibly done for today. And we could see a little bit of a reversal. So I'm going to sell that now at 71.92, and I'm going to put a stop loss at 72. Well, let's just go aggressive, shall we? Let's just say that is the top, and we'll go at 72.08, targeting a move down to 71.37. So 3.3R on that one today. Looking for a move to the lower end of the typical range that we've seen over the past 20 days.
Excellent.
Okay, news-wise today, as we mentioned, we've got Jerome Powell speaking later, and I guess he'll be talking about inflation, he'll be talking about government yields, and talking about a way through the recovery. We've also got, in 15 minutes time, UK construction PMI activity is expected to rebound, moving to 50.8 from 49.2. We've also got US initial jobless claims at 130. Claims are expected to fall to 715,000. That may be watched ahead of non-farm payrolls tomorrow. So plenty to keep your eyes open for, and we may have some commentary out of the OPEC Plus meeting as well, as they try and resolve the question as to whether or not to raise production. So plenty going on. Trade safe if you're involved in the market. Steve, we can wrap it up now, unless you've got anything else to add.
No, that's all cool.
Super. We will be back tomorrow morning then.
All right, brilliant. Cheers.
Good luck, everyone. Bye-bye.
Bye.